right, well, good morning, everyone. For anyone new here this morning, my name is Shelby Pritchard. I am the Pest Management Specialist here at SDSU, as well as the moderator for the Crop Hour webinar series. Thanks again for taking time out of your morning to be here with us. A couple of quick reminders. There will be a short poll after each presenter this morning, just a couple of questions. We ask that you fill that out. It just helps us for future programming. Also, there will be a CCA credit available after each presenter. I'll make sure that's up long enough for you to take a picture of. And also feel free to ask questions throughout the presentation. We're happy to answer any questions. And just to jump right into it, our first speaker of the day is Dr. Matthew Diersen. Matt is a professor and Extension Risk and Business Management Specialist here at SDSU. Matt earned a BA degree in economics at the University of Minnesota, a master's degree in agricultural economics at North Dakota State University, and a PhD in agricultural economics at the University of Illinois. His SDSU extension programming focuses on the interaction of commodity marketing and insurance tools and on changes in the agricultural economy. He actively shares commodity market and agricultural sector analysis with producers, lenders, and the agribusiness community in the Northern Plains. And today, his title of his talk is Crop Insurance Considerations.
All right, thanks, Shelby. I'm going to start a screen share here. All right, let's take a look then at some of the crop insurance considerations. This will be a big picture look, mainly as it relates to the interaction between crop insurance decisions being made right now and commodity marketing decisions that will be made for the 2022 crop year. But between Jack and I, we're also taking a little bit of a peek or a look at what that might mean for 2023 as well. So let's take a look at some of the insurance aspects and things happening right now. To set the stage, want to look back just briefly at 2021, just to show some of the common decisions that were made last year and what that might mean for 2022. So if we look at the big three crops last year, corn, soybeans, and wheat, you can see the acres insured in South Dakota, just shy of 6 million acres of corn and 5.3 million acres of soybeans. You can also see the liability there that shows the dollar amount. So $3.3 billion of insurance coverage on corn and $2.2 billion of insurance coverage on soybeans. So had the drought gotten worse, that would have been the maximum payout on the two crops. As it was, the way the conditions played out, this wouldn't be a final number yet, but you can see on the right-hand column there, the indemnity column shows that there was about $340 and $165 million respectively of insurance payouts on corn and soybeans during or tied back to the 2021 crop year. So that sets the stage that's what had happened. If we do a little bit of a deeper breakdown, these two slides here will be the same exact picture if you looked at soybeans compared to corn. But starting here with corn, if we look at what happened in 2021 with corn acres insured in South Dakota by coverage type, this Pac-Man-ish looking figure here shows that 98% of the corn acres in South Dakota last year were covered by revenue protection. Only 2% of the acres were covered by anything besides revenue protection, and that's a cross-section of things. Small number of acres covered by catastrophic coverage, a small number covered by yield protection, only a small number covered by revenue protection with the harvest price exclusion, and a small handful covered by margin protection insurance. So the vast majority of acres last year covered by revenue protection, and that seems to be reasonable because of revenue protection being tied to the futures prices and the coverage adjusting as futures price changes. So I think that's probably going to be repeated in 2022, given the price variability and price levels that we're seeing right now. The other aspect that helps to do a look back on is the coverage level. This is the 2021 South Dakota corn acres. The soybean picture is very similar, but it shows the largest spike, or the largest level of insurance by coverage level happened at the 75% yield election level. So 3.5 million acres, give or take, in South Dakota covered at the 75% yield election level. So a couple ways to look at that. That 75%, if something like that number is repeated 2022, that would mean that about 75% of the value of the crop is covered by insurance. That means 25% totally being self-insured, or that would be the deductible level faced by the grower. That also means that that portion of acres not insured may need to be managed, marketed in a different way because the insurance coverage is not there to make up any yield shortfalls. So just wanted to point those out as ways to look back and see, to give some indication of what might be happening in 2022. Now, rolling ahead to the 2022 insurance year, we are in the active price discovery period for corn, soybeans, and spring wheat in South Dakota. The crop insurance products will tie to the new crop futures price levels taken on an average during the month of February for corn, spring wheat, and soybeans. So this data shown for 2022 is preliminary. It's the average through yesterday. This morning will have an influence and be included in that. So you can see there for soybeans, for example, it was at 14.19 as of yesterday, and that would be an all-time record high level for a price election in spring. So the highest coverage available is available right now on soybeans for the 2022 crop year. The other one probably of note would be corn along the bottom there. That price election as of yesterday was sitting at $5.87 a bushel, $5.87 a bushel. That is slightly below the all-time record high. Back in 2011, the price was $6.01 per bushel. So taking the average for the entire month means that you've got the price trailing a little bit at this time from that record level back in 2011, which dropped off my chart here for the new marketing year. So that's the insurance election levels. High levels mean insurance will cost more from that standpoint, but you're also getting a lot more coverage for the marketing year. The other aspect that also is being measured actively or actively recorded at this time, the crop insurance cost is tied to the volatility in the new crop futures prices. So those have become a little more volatile in recent days. The volatility levels get scaled or the implied volatility in those futures markets gets scaled for the percent of the year that the insurance is in place. So for example, right now, new crop corn yesterday had an implied volatility level of 27%. So if you're trying to look it up on the board, you'd have seen something like 27% volatility. That translates into 22% volatility loading, or a volatility factor for crop insurance. The point is, or the takeaway is, that for both corn and soybeans, the volatility levels so far for the month of February running a little bit lower than, or very similar to, the level from a year ago. That's not, that's sort of mid-level volatility at this time. It's a little higher than it was a few years ago, like 2018, 19, 20, but nowhere near as high as the volatility, which got into the 30s and 40, close to 40 in the 2007, 8, 9 time period in there. So, so kind of some mixed news. You've got high prices, but volatility is staying in check. We do want to take a couple of different looks, or give you a couple of different perspectives on that volatility, both now and what that's looked like. So this is a snapshot of the nearby futures price, so not new crop, but nearby futures price volatility for corn and soybeans overlaid daily over the last 5 years. It's a busy chart. Let me point out just a couple of things. I think you can see my pointer on the screen, or I'm assuming you can. So we've got the recent volatility increase right here. Now we've got this period back here last summer. So June, July timeframe, the volatility on those nearby contracts spiked to 50%. So it's very possible for volatility to move around a lot during a year, throughout the year. And just wanted to give that perspective. There's times when, for example, corn can have high volatility levels and soybeans not have high volatility levels. Other times they move together. So I'm not saying that they're always related, but they can move together. They can have a mind of their own, if you would, at times as well. I've got two other snapshots breaking this out. So that's looking backwards at what volatility has been like. Now, what's the current look for the volatility looking forward? So here's a snapshot of corn price volatility looking from today. So on the left-hand side is the current contract, starting from today, or the nearby, going out all the way out to December of 2024. So 2 years from now. And if we look at the chart, or the snapshot in the upper left-hand part of the screen, we can see that the volatility peaks when we look at September, or the September contract time. So predominantly in corn, the volatility is happening in old crop and not necessarily in new crop. And the volatility is also, where it's red, that's where high price levels are happening. So the concern, or the volatility, is old crop. And the concern is that the market is concerned about sharply higher price levels from the levels they're already at. But things do settle down or calm down a little bit once you get into new crop, and it gets much lower when you're talking about volatility for throughout 2023 out there to December of 24. So December 23 is right there, and then it's a little bit higher as you get into 2024. So quite the far ahead look. Soybeans, a similar pattern, with one exception, the new crop volatility level. So the volatility specific to the November 22 or new crop contract is a little bit higher, or it doesn't have quite the sharp drop off that you see in the corn market. So here too, all soybeans are under some concern with price volatility, especially at the higher price levels. So again, you have the same pattern: high volatility or the volatility is higher at the higher price levels, meaning it's harder for a processor right now to lay off the risk of high prices. Coupled with that, because we've got the access to the Bloomberg financial terminals, we've got a couple of views or snapshots here showing what is the current futures price situation relative to, in this case, the last 15 years. So I know this is a busy chart and probably hard to kind of isolate, but if you look here on the left-hand side, the bolder, thicker light blue line is the current new crop December futures contract price. So it's been, to move a screen here slightly. It's been in that $6 as close of business yesterday. It was $6.09, 9.5 cents per bushel. It moved into a territory where it was the highest price at this time of the year, at least over the last 15 years, but just based on general knowledge of the price of corn, we've never had the futures price this high. So I went back and grabbed the last couple of times where prices had been this high. You had the 2007, 2008 year and a couple of other more recent years where the price gets higher later in the year, but this is the time where you've never had prices this high at this time of year. So that shows up starkly on corn, and the price can go down substantially between now or midsummer and the time that these prices actually expire or the contracts expire later in the year. Similar thing on soybeans. Soybeans pretty much since the beginning of February or mid-January into February. We've got the light blue line there showing new crop 2022 soybeans, and it's trading at levels not seen at this time of year for that new crop price. So you'd have to go back to, again, 2016, 17 and 11, 12 to get prices higher than what we're seeing right now in new crop. So throwing those out there as some things to consider or think about. Now, tying that back to crop insurance in particular, with that adjustment, we're in the projected harvest price discovery period right now. So here's a zoomed in look at just the last 5 years. So 2017 through 2021, just for perspective. I've got two price charts. So the first bar is the projected price. So that's the price during February, and the harvest price is that same futures price. So December corn futures, where the average is taken during the month of October. So February of 17, October of 17, you saw that year the price fell from December through October. Same pattern happened in 2018 and 19. 2020 and 21, both those years, the harvest price ended higher than the projected price during February. The other thing that shows up, so you don't know what this year's October price is going to look like, but it's going to be relative to this starting price. Also overlaid on here is the October cash price. That's the NASS price received by farmers for corn. So that's a survey price done during the month or relative to the month of October. So October cash price. And I just maintain that price history just to see the comparison between, or to give you an idea of the basis at harvest time. So the difference between the harvest price and the October cash price would just be the a representation, at least, of the basis at harvest. So negative basis, narrow basis, but still negative basis, narrow basis in 2021. Looking ahead to 2022 for that basis level, the 5-year average, so the average from 2017 through 2021 would be 41 under. So I'm showing this October cash price is just this futures price minus 41 cents a bushel, just to get some idea of a cash price to think about for 2022. Also shown on here, just zoomed in, is the volatility, just to show that that volatility is a little bit lower than last year and a little bit higher than 2018 through 2020. Similar pattern shows up for.
I was going to ask you a question before you leave that slide.
Sure.
Yep. And I interrupted your thought.
No, go
process.
ahead. Go ahead.
Okay. Will that volatility change for pricing insurance? Sorry about that.
Yes, as the volatility fluctuates. So right now it's a little bit lower than last year. That would mean that part of the insurance cost formula would be a little bit lower, but you've got a higher price level that you're insuring. So that's going to push up the cost of insurance. So if I had to guess right now, I'd say higher price level means higher insurance cost, but lower volatility means slightly lower insurance cost. And call your agent and have them run a quote.
Yeah. The other question, just to kind of follow up on that,
Yep.
Does that tracking stop when they stop the price selection?
Yes. So the volatility gets decided during the last 5 days of February, or the last 5 trading days. So all of today's price volatility gets added to the mix.
Okay.
And we had some limit up moves today. So I believe all that gets added in there. Now, again, the price level's going up, so higher price is going to factor in. But what you don't want is higher volatility. As a grower, you don't want high volatility the last week of February. That's bad. So,
thanks, Matt.
Yeah.
Yep.
The same pattern holds, general pattern holds in soybeans. So again, much like corn, price fell a bit, 17, 18, 19, rose in 20 and 21. You can see that these differences between the harvest price and the October cash price, that's basis. And that's, it's wider. The scale is different here. So the last 5 years, South Dakota, that basis has averaged 80 cents, minus 80 cents or 80 cents under. So wide basis relative to the corn basis. And if anyone is interested in a longer history, I've got this history for corn and beans going back to 2002 with the projected and harvest price and volatility levels and those historic changes between spring and fall. And most of that information is available through the RMA website as well, but it's nice to have it in one spot from time to time. So I'm going to wrap up with just some general observations for 2022. Just a reminder that revenue protection really complements hedging. So given the price levels available right now, revenue protection brings a lot of advantages that really complement forward pricing or taking steps to mitigate price risk. So revenue protection's got a lot going for it in a year like this. Expect the coverage level to remain steady or perhaps be under a little bit of pressure because of a higher cost of insurance. So it is another input cost that needs to be managed. But you have competing forces working against a higher price level means more likely to consider hedging. So you'd want more coverage or a good level of coverage, but if its cost is higher, that gives you an incentive to back off that coverage a little bit as well. But I would expect it to be fairly steady. Given where prices are at, basis will just continue to drive that choice between pricing some of this corn or soybeans using futures versus a forward contract. So knowing that the basis has continued to be wide on soybeans relative to corn, you expect to see perhaps a little more forward contracting of corn and a little bit more tendency to use futures in the short run on soybeans, but that can change. That can change as the forward bids change. So just something to be conscious of. Number 4 there, put options on new crops. So put options against the December corn or November soybeans. That would be a way to round out a hedging program that would fit or fill in the gap between the insured level of bushels and uninsured bushels. So especially handy if your yield records or your yield performance has outpaced your insurance proven yield level, you might have a gap there, and put options would be a way to fill that in. You might look at fences and collars. So if the volatility were to continue to increase, fence strategy would be buying a put and selling a call option. And sometimes that's called a collar, or more often called a collar in the trade language, but you probably, if you've been around a while, you've probably learned it as a fence strategy as well. Not to confuse a fence with buying a put and say selling 2 call options. That gets to be risk additive rather than subtracting or managing risk. And number 6 there, if you've been aggressive already or going to be aggressive making sales, just remember that crop insurance stops once the price reaches 200% of the election level. So that's true for revenue protection. So you don't have unlimited upside protection. And that is something to be conscious of with inflation pressure and the price levels we've seen on old crop corn and soybeans. So thinking in terms of your coverage ends at $12 corn, or your coverage ends at $30 soybeans, which is hard to say. But just be aware, but the way to protect or mitigate that is using out of the money calls to cover aggressive forward and futures contract sales on 2022. With that, I'm going to stop. If there's a clarification question, I would take it. Otherwise, I'm going to stop sharing my screen.
All right, well, thank you so much. Go ahead and throw that up. All right, and why I have that CCA credit up, if there aren't any questions right away, I'll go ahead and introduce our second speaker of the day, which is Jack Davis. Jack earned his MBA from University of South Dakota and his BS from South Dakota State University. Jack has worked with SDSU Extension for 25 plus years. He currently serves as a crops business management field specialist from the Mitchell Regional Office. His responsibilities include developing and delivering educational programs on business matters facing producers. And Jack works with team members on publications and programming, including Economics of Soil Health, Land Market Survey, Farm Financial Trends of South Dakota Farms, Crop Planning Cost, and Production Budgets. And today he is going to be focusing more on profits and market outlook for 2022. And with that, I will stop screen sharing.
And am I going to load those, or okay, Matt's doing it. That's fine.
Yep.
That'll work. Okay. Now we got to go down to where I was at, Matt, or where you finished in full screen him. So just gonna take a look at acreage, because that'll be our major, probably USDA report that's coming out next will be our planting intentions. Just taking again a big picture look. So this is all principal crops. So everything that we get measured, everything gets thrown in there from a US standpoint, cotton, potatoes, so measuring all the crops. And I think the thing that we just want to pick up on this, that we are right at 317 million acres of total crops, and it peaked in 2014 at 330. So do we have room to go up? Possibly. Will we? We don't know. We'll see. At least up here in the upper plains, it's kind of looking like planting conditions will get started early, and we'll roll right through. But once you say that, that probably changes the weather conditions. So next one, Matt. Again, just showing the same thing with USDA's figures, taken from the WASDE. And next. So then I'll break him down into South Dakota's. So I got the principal crops using the left-hand scale. That's a total of all our crops. So it includes hay, sunflowers, everything's included. And then I broke out with the blue line our corn acreage and our soybean acreage. We've reached a kind of a peak of around 6 million with our planting intentions. And our corn and soybeans are pretty even in South Dakota. So I would probably anticipate that being the same, even probably with our higher fertilizer costs. I think the producers tend to prefer corn. We probably still have enough livestock in the state that there's still a lot of corn production, and I would not anticipate a great big switch is what I'm saying there. So total, is around that. On our peak was a little over, well, almost 18 million acres, and we are down about 1 million acres from that in recent years. So we would have possibly room to grow in that area. Next. And this is just showing those three larger crops individually. Like I said, we're right between that 5.5 million to 6 million acres for our corn and beans. And we did last year actually put in, I think, more bean acres, or at least we intended to. Next, Matt. So now showing the June acreage minus the March prospective planting intentions. So do we end up in South Dakota planting what we said we were going to plant from a survey standpoint? And then I broke it out. So in the years when corn goes up in acres, it goes up by about 370,000 acres. And that's taking out the zeros. It's just the years when it goes up. I went back to this 2009 timeframe to 2021. And I misspoke. It goes up 350,000 on average when it does go up, and it goes down 370,000 when it does go down. And when I did this, I took out the 2019 year, because that was our major prevent plant year, and everything got kind of skewed. So I did take that year out, but otherwise it was those years. If we average them all together, there's not much change between what we say for our planting intentions and what we actually get done. If you throw them all together, and again, taking out 2019, it's 37,000 acre increase for beans and a 21,000 on corn. So it ends up really being very close to what our March intention report is. Next. So looking at crop budgets, and what I have here is our variable costs and direct costs in the blue, and then I've thrown equipment and labor in together, and then there's the green would be our return to land and management. So in that green, rental rates have to come out of that, and this is for eastern South Dakota with a higher productivity, what I'll call higher productivity. So 225 bushel corn, and then accordingly for the other crops. And I used yesterday's, probably midday, actually it would have been Wednesday's, like a cash bid out here from Alpena. So that's where the selling price came from. One thing we had talked about earlier was those basis. We see for this area in the mid part of the state, soybean basis, even on new crop bids, being fairly tight. It's at 40 to 45, and you know, as Matt said, sometimes you get into harvest that can be up to 80 cents. So right now they're still being aggressive in those new crop bids on a basis level. So there's even, and I do have the higher fertilizer, nitrogen is priced in here at 91 cents. And the other fertilizers accordingly. You hear all the talk of availability, and I think the key on managing your fertilizer is be talking with your supplier. I think most guys have probably purchased some or locked some up. If you're changing in your plans, be sure and communicate that. If you're cutting back some, communicate that so you can help that supplier manage his inventory too. They're in this really kind of same boat as the producer in managing their volatility and that inventory that they have. We are up probably, depending on the individual or the operation, anywhere from probably 30 to 45% from last year's input cost. So that means you have more at risk, really, going into this crop year. You know, facing some of the uncertainties that we have with supply chains and inflation and other costs, it's just going to be key to manage that working capital and do the best you can and manage that as you work through your crop inputs. Next one. So just wanted to kind of show where the major exporting countries are, and I think was maybe just showing what type of grains come out of that Ukraine and Russia area. So it is on a world level, Ukraine exports almost all their corn that they produce, and that's at that 34.5 million metric ton. And Russia doesn't export a lot, but there would be some more. Just wanted to show it, because it's probably on everyone's mind on well, what happens there. Well, we don't know, there'll be some disruption, but I would feel that somehow those ships and exports would continue. It may just be under a different flag. Next one, I think, shows the wheat. And here, Russia and Ukraine have a larger percent of the total world exports of wheat. So just wanted to share those as a thought. The other thing that probably gets affected there is that there is quite a bit of fertilizer that is produced and exported out of that area, and all types of fertilizer, and their low cost, high volume production of fertilizer products. So that'll be something will not so much for this year's market, but as we move forward and move into the next year or towards the end of this year for our northern production here. Next, Matt. Just showing consumer price index and where we're at. And right now we were in our last one, we're right at 7.5, I think, in showing this for all items. And then the red is taking out the food and energy. So just showing that core inflation. We've run along for a long time with it staying fairly low. Almost since really 2000, we did have some peaks in there in 2008, and then we kind of had that recession that came about and really dropped it. And otherwise, we have really stayed right around that mark of the 2%, which the Fed kind of tries to target as that 2% level for inflation. It right now, things would be looking that it's going to continue. So I think we'll move to our next slide. And one of the ways to slow that is with a raise in interest rates. And we would anticipate that there'll be, anywhere from 3 to 5 interest rate hikes throughout this year to help slow that inflationary process. So we'll see where that goes. Probably for this year, most people have their operating lined up and locked in, at least for the year, and probably at a pretty decent rate for this year. So again, the key will be managing that working capital and watching our balance sheet structure so that that we don't get tipped out of line there. We've really stayed under that 5% for a long time. I think that's kind of key. This is on a 10-year treasury. And if we look back, we talk about the 70s or the 80s, I should say, where interest rates really took off and caused our farm financial crisis. Look how long we were above 5%. It was a long time, and then it took, had to get inflation tamed down, and the interest rates were spiked. So we want to build our first defense again. I'll say it again, with that working capital and that position to help us weather through these tougher times or uncertain times, and that'll be key financially. Next, Matt. I think that might I don't know what else I had. Yeah. So then we're kind of back into, we want to look at, and we'll just share this if that's okay, and keep going till we're finished, right? Or so, yeah, so we got, this, I can't see it very good, Matt. Were we 22 or 23 here? 22.
So this is all new crop overlaid on the same chart. So you've got the open, high, low, close is the 2022, December 2022 over the last year. And then overlaid underneath it is the 2023 in the orange, and then the 2024 in the blue, and the 2025 in the jackrabbit yellow. So so new crop is here, and new crop is 570 as of yesterday's close. So between Jack and I, we discussed this a little bit. It's like, are there or what's happening, and is it time to start, or maybe you've already started thinking about what could be done to market or move some of that 2023 crop into the market. So Jack, did you have a thought on this too?
I just think that if you have, say your owned land and machinery is not going to change, you have a lot of those costs locked in, it's surely time to at least start thinking about and what you might use as tools in pricing some of that 23 and possibly even 24.
Yeah,
is my thoughts. Yeah.
The 23 looks, it's the starkest here right now on corn. And, really since the beginning of 2022. So right here is 22 started. So since the beginning of the year, the 2023 price has tracked fairly closely to the 2022 new crop price level. Now, related to crop insurance, and the reason Jack and I put this on, it was on our radar screen, you won't know the crop insurance price election until February of 2023. So it's probably a case where you'd think more in terms of perhaps put options or using futures, just keeping in mind that you don't know precisely your insurance level for the next crop year. So it's not saying you need to go out and be aggressively pricing or something like that, but you're probably looking at using futures rather than forwards for a while. Or if you are doing some pricing, you might want to be doing some covering of those sales as though you wouldn't have, or because you don't know your crop insurance level. So selling futures and covering it with some extreme out of the money call might be a way to think about or approach starting to price some of those bushels.
Yeah, I just think we get these run-ups and it's at probably profitable levels. You want to know that for your specific operation. It's something to, like Matt said, put on the radar. Maybe not necessarily get aggressive on it, but don't let it slip away either.
And we've got the, I'll jump ahead and show the soybean view as well. So the top price series is new crop 2022 soybeans. So November 22, below it in orange is the 2023. So the soybean 23 contract has not kept as as fast of a pace as the increase in the 2022, or the increase or the change or most of the motivation is in the corn side of things, even though there's nothing wrong with a 1330 futures price here, but it hasn't gone up quite as dramatically as the 2022 crop. So that's why new crop 23 corn is maybe the hottest commodity to be looking at. But certainly these are all prices and levels to get a person thinking. Jack, I have one or two additional things maybe to explain or show.
I would say if people have questions, feel free to ask them, and we do probably I think we got time yet here to show these.
Do we have some questions, Shelby?
There are currently no questions at the moment.
Okay, I'll just keep going for a second or two then.
Yep.
All right. So on the screen here, just to show, there are currently some open interest in the December 23. So this is a good 600 days till expiration here, but there are some open interest puts and calls for that December timeframe. So December of 23. Notice the spikes. This is not uncommon, but there's spikes in terms of larger open interest levels anchored around big round numbers. Like these are call options. The largest blue spike here is call options at the $6 strike price. There's another big spike at $7. So for 2023, those in the trade are concerned about high prices. Just like old crop, just like new crop, they're concerned about $7 corn, $8 corn, and you've got blocks or lumpiness as people anchor around nice round numbers, $4 corn, 450, 556. So those would be not to encourage or discourage, but just be conscious of that you're probably looking, or the place to look for some trading volume is probably around those anchor price levels as well. And the other way to think about, or something to be conscious of, there are, in addition to the regular futures and options contracts, there's short dated new crop options. And those might be something to consider when you start thinking about managing the fact that you don't have the insurance coverage in place for 2023 and beyond. What might you do? You could use some futures or some regular options, but you might also look at or consider short dated new crop options, which would settle or expire against, say, the December 23, December 24 contracts over time. So if those aren't on your radar screen, it's worth considering, or I would expect to hear more about those contracts and options going forward. I think that's what I had for prepared remarks. Are there other questions? If not, here is my contact information, and Jack's is readily available through extension.sdstate.edu. And just want to also share our policies, USDA policies as well.
And then when you're done with that, Matt, I will share that last CCA credit with everyone.
All right.
Let's see.
The other thing, USDA is holding the Ag Outlook form. So if you're wanting to stay inside this afternoon or tomorrow, those would be good programs that you can take part in virtually. They did come with their acreage estimates in that Outlook form. Nothing surprising there on corn, 92 million and 88 million on beans. So maybe a little bit low on beans, maybe a little bit low from what the trade's expecting on corn.
We'll be doing a deep dive on those the next little bit yet today, and then tomorrow I've got my our commodity trading class. We're going to try to watch a little bit of those in real time, just to hear the presentations and take a look at the different price situations.
One of the things, Matt, that you and I have been talking about is the renewable diesel. Did you say they had a session on that they're going to talk more on that?
Yes, I think it's part of the crop outlook session, which from memory, I think is 9 a.m. tomorrow morning, or 10 o'clock Eastern time. So, but that's when that is. So crops, and then right after, I think right at noon, you get some of the livestock as well. So
Great. Well, if there aren't any questions, we once again appreciate both of you being on today and talking with us. And we hope to see you tomorrow when we will be discussing water and water management. So thank you, guys.
thank you.